Thank you so much. Now I would like to introduce today's keynote. Tom Woods spent his entire career with CIBC and Wood Gundy, the predecessor firm of CIBC World Markets, initially in investment banking, advising companies on raising financing in the capital markets as well as in mergers and acquisitions. She later was head of Canadian corporate banking, chief financial officer, chief risk officer, and retired in 2014 as vice chairman. Tom serves on the boards of Bank of America Corporation, Merrill Lynch International, which is Bank of America's broker-dealer subsidiary in London, Alberta Investment Management Corporation, St. Michael's Hospital Foundation, and the University of Toronto College of Electors. Tom previously served as board chair of Hydro One Limited, Unity Health Toronto, and Covenant House Toronto, as well as on the boards of TMX Group Inc, Jarislowsky Fraser Limited, DBRS Limited, Covenant House International, and the Canadian Opera Company. Tom has a BASc in Industrial Engineering from the University of Toronto and an MBA from Harvard Business School. So please join me in thanking Tom for being here today and accept this gift from IISE.
Thank you. They get the gift before I do any work. That's good. Thank you for holding out to the end here. Let me just add my congratulations and thanks to all the student and academic participants and the winners and all the volunteers that have been part of this fantastic organization for as long as I've been an industrial engineer. I haven't practiced actively as an industrial engineer, but I must say I've used the fantastic training I got at University of Toronto all through my career. Most of my career has been in banking. I live in Toronto. Let me get my clicker out here so Pascal doesn't have to do the work. And I really hope you've had a great conference, but I hope you've had a chance to see a bit about this great city of Montreal. I am from Toronto, which for those of you that don't know is about 350 miles up the St. Lawrence River. But Montreal has had a very significant influence on me. I came to Montreal in 1980. I was transferred to Montreal when many Anglo-Canadians were going the other way, and it was an unbelievable experience for me. René Lévesque, those of you that are from Quebec, and perhaps some of the others of you know, he was the premier, which is kind of like a state governor if you're from the U.S., incredibly charismatic Quebecois leader. He was here when I was here. Watch some video on Lévesque. He's just an amazing guy and a real huge influence even today on the Quebecois culture here in Montreal. I moved back to Toronto in 1985, met my wife, who herself was from Montreal, through our mutual boss, my boss when I was at CIBC in Montreal and her boss when she was at Scotiabank in Toronto. We got married, had 2 kids. Without Montreal, none of this would have happened. So I'm eternally grateful and I'm delighted to be here. I'm going to go to the podium just so I'm a bit more effective and don't lose my spot. And we'll get into my story about banking and the linkages it has to industrial engineering. So let me get to my script here. This is me. I think I was about 10 years old. And growing up in Toronto, as you've heard this refrain from some of the other speakers, I didn't know what I wanted to do in life. In grade 5, we had to write a life story up to that point to describe what our ambitions were. Like any good young Canadian boy, I wanted to play for the Leafs. Now, those of you from Montreal want to play for the Habs, obviously. By grade 7, I knew that was not going to happen, so I had to have a plan B. Plan B was to become a doctor, but I soon abandoned that path as well. In high school, math was my favorite subject, as it was, I'm sure, for many of you in high school. I was unfamiliar with engineering until I went to a presentation at University of Toronto. Engineering seemed like a practical way for me to apply my math skills, so I went into industrial. In my summer job at the steel company called DeFasco, Dominion Foundries and Steel, in a city called Hamilton, just outside Toronto, after 3rd year, I helped design a material handling system. I was a student, so I played a part, but a small part, for steel ingots involving cranes and rail cars. I was pretty proud of that contribution for the summer. I returned to school for my 4th year. I called my boss up and said, how's it going? Have we built that steel material handling system I helped you design? And the answer I got was the thing was not going to proceed, okay? At least not right then, because the board of directors had not approved it. He said the reason was the cost of financing in the bond market was too high. Well, I had no idea what the bond market was, but this news was disappointing. It then sunk in that unless the product of engineering design was in sync with the financial markets, it might never get built. So that was a wake-up call. And I thought to myself as I sat in the class of my final year of engineering at University of Toronto, that I had to learn more about these financial markets and about business in general. So I signed up to do an MBA. This was a tough call because I really liked engineering. I'd grown up in the working class suburbs of Toronto, and to me, banking was the small branch at the end of the street. Not to me a very exciting place to have a career, so I thought, but soon after I arrived at business school, I found that banking and finance presented a whole new world for me to explore, much like I discovered 4 years before when I started in engineering. I soon found that several of my MBA classmates had just spent 2 or 3 years working on Wall Street as analysts, pretty junior position. I didn't know what an investment bank was. It soon became apparent to me, however, that these banks from Wall Street were indirectly complicit in my material handling system not getting built, so I thought. So I got a summer job between my first and second year MBA at CIBC's investment bank in Toronto, then called Wood Gundy, and it all started to make sense. I returned to CIBC after graduating from MBA and spent my entire career there, something that, kids today rarely do. 37 years in a wide variety of jobs, ending up with the chief financial officer job and ultimately vice chairman. I saw and even had a small hand in some of the significant change that the banking industry was going through, a good part of which involved process change and technology. And a good part of that was driven by engineers, industrial engineers. So I want to talk a bit about this change. Less about the past, however, and more about where banking is going, about change the customer sees, and change that's happening in the background, largely invisible to the customer, but which is driving the faster, better, cheaper that banks and virtually all companies today are seeking. Change driven by innovation, process reengineering, data management, early work in AI and blockchain, and the use of the cloud. I'll then rise up a level to something I know a little bit more about than the hard engineering, and talk about my second nemesis from that summer at Dofasco, corporate boards of directors, which still oversee and ultimately approve or not approve a lot of this technological change. And I'll conclude with some stories of industrial engineers and the important roles they're playing today in the banking industry. So these comments are my own. They're not comments from CIBC, where, as I said, I spent 37 years, or Bank of America, where I've been on the board since 2016. Okay, first, a bit of context. Yeah, and some of this, maybe all of it. Not all banks are the same, but there are many common elements. Almost all take deposits and make loans. Most provide investment services. Some do investment banking and trade securities, and all banks are regulated. But there's some big differences. In Canada, those of you Canadians, it's an oligopoly here, 6 big banks. The US has about 4,000. The vast majority are middle-sized and smaller banks. And Europe is in between. The UK and France, for example, each have about 400 banks. In many countries, there are emerging banks which lead with their technology, alongside our larger incumbents, traditionally and typically with older tech platforms, but strong legacy customer franchises. And now there are many companies, large and small, that are trying to get into the banking industry. Like most industries, banking is going through a huge digitization revolution. Customer digital usage has gone up dramatically since the pandemic, since before the pandemic. And this increase was going to happen anyway, but the pandemic obviously has brought a lot of that forward. And it continues to grow in features like electronic payment and money transfer, chatbot use, self-directed stock trades, and the completion or near completion of product purchases, such as mortgages, credit cards, and the opening of deposit accounts. At BofA, over the last 3 years, check usage is down a further 25%, and it had been declining, obviously, before that. Electronic money transfers had more than doubled and now represent more than 2 times the number of checks written. Right now, 75% of BofA's retail customers are active digitally, and almost 90% of its wealth management customers are. And these numbers continue to grow. So our son, Derek, he's now 30. He was the little guy you saw earlier, and he was captured at a conference by New York Magazine along with some of the other kids. Currently works in New York for a large startup in the digital identity space. It's called Persona. I mean, there's hundreds of companies like this. He's moved around every couple of years to try to up his learning in that space. His job and his curiosity has driven him to stay current on the fintech world, and he's kind of my informal consultant on that space. And whereas my wife and I value and rely mainly on our historic banking relationships, his approach is quite different, perhaps similar to yours if you're of his generation. He uses BofA for his salary direct deposit and saving account, mainly Venmo for money transfer. I don't tell the BofA people that. Robinhood for stock trading, and Coinbase for crypto. Now, in time, he may gravitate, as you may, to a more relationship-based approach to banking. But for now, he, a bit pretentiously, calls it his multi-provider financial stack. I mean, he doesn't have a lot of money, but he likes to experiment with a bunch of these fintech players. His choices reflect his transactional orientation, but also the success some of these fintechs have had in entering the market, typically with a fairly narrow set of product offerings. Now, time will tell how they will do as they try to cross-sell new products when they roll out. Most of them today are still pretty focused on either a deposit product or a lending product or a money transfer product. The incumbent banks, for their part, continue to invest huge amounts of money improving their user interfaces and the myriad of systems and processes that lie behind these interfaces. So if we can get the tech to work, I'm going to show you just a 30-second video of BofA's Erica chat box, which we've had up and running for about 5 or 6 years.
Imagine staying one step ahead of your money with Erica from Bank of America, the virtual financial assistant that works with you, your life, and your goals to take them to the next level. What would you like the power to do?
So I'm not here to push BofA. I mean, all the big banks have similar apps to this. Erica is one of the first ones and arguably one of the most successful ones. Quite a change from banking when I grew up. Those of you that are students, I mean, this has just been part of your life probably from day one. Quick story, I had a newspaper route, as some of those of you of older generations have, maybe younger generations, although not many newspaper routes these days, I suppose. When I was 12, every 2 weeks, I made a physical cash deposit to that bank at the corner, okay? The cash I collected from my customers. I then wrote a check to the head office of the newspaper to pay for the cost of my papers. I deposited money. I presented my bank book to the teller in the branch every time I deposited money. And then the teller would check the filing system and see if I'd written any checks and handwrite that in my physical bank book, handwrite it. At this point, there was no sort of computer printout. So how did banking get from there to where it is today? It started, as it did in all the industries you are working on, with innovation, a commitment to innovation right across the business. Now, today, there's a tendency to think about the fintechs more so than the large banks. Let me get the right. Oh, there we go. Now I went back too far. All right. There's a tendency, I think, to think of the fintechs more than the big banks as driving this innovation. Now, the latest fintechs do have the advantage of building their tech stack from scratch, okay? And many of them have been supported by innovation-minded private equity firms who have a higher degree of tolerance than the stock market for business models that are customer growth-driven rather than profitability-driven. But innovation lies at the core of the big bank's DNA as well. And it's paying off. Not too many years ago, customer sat ratings at the fintechs were higher than those of the large banks, but today they're essentially the same. The Erica virtual assistant you saw a moment ago and others like it have transformed personal banking rather than the narrow transform personal banking, providing a gateway to virtually the entire product array rather than the narrower product focus of a typical fintech. Zelle and Venmo have revolutionized money transfers. Self-directed investing through Merrill Edge and others have changed wealth management with lower price options for those who don't feel a need to access and consult more personalized services. The scale and financial commitment of the large banks has been instrumental in enabling this innovation. For example, BofA now spends US $4 billion annually on technology initiatives. That's not just the tech department, that's the initiatives as part of a $12 billion tech budget per year on a cost base of about $60 billion, okay? A lot of this $4 billion is spent on work by developers and the supporting systems that make this innovation possible. Large banks' infrastructure is generally centralized so that there's standardization across the bank. It's available 24/7 with backup sites and redundancy at locations around the world. It consists of thousands of applications, tens of thousands of servers, thousands of change requests per month. I'll come back to this infrastructure in a moment, including some comments on the thousands of related processes and data management systems. But first, a few words on technology development, because it's the developers who are really driving innovation. Now, banks build or buy applications to be used both internally and by customers. These applications have to be intuitive, but also address a wide variety of user options and preferences, and of course include all the necessary legal disclosures. And they have to be resilient against attackers. The key to all this is to have an environment where developers can flourish, where they can be free to be creative, but operate responsibly in an industry that's closely regulated. Recruiting and keeping developers and training them is critical. Overseeing the production processes effectively is also critical. Including monitoring the time required to onboard developers, the time required to get applications into a production environment, and the time required to remediate issues or risks. I'm told that many large banks' development processes are now gravitating from what they call a waterfall approach, okay, where the full requirements are written, designed, coded, quality checked, and then released, typically 18 months after many handoffs between teams. That's before. To what is now known as the agile approach, where cross-functional teams work in pods led by a business owner and where they are all aligned to a set group of outcomes. They create ideas and break them down into bite-sized chunks, typically 2 weeks' work, to achieve the desired outcomes. Okay, back to banking infrastructure and specifically processes and data management briefly. Now, does anybody know who this is? Now, come on, this is a conference of engineers, industrial engineers. Anybody know? Got it. Right up front. Your next president, Fred Taylor. Did you see this script before? No. Fred Taylor. Very good. Taylor was born in and by the way, she said the founder of industrial engineering. Okay, you knew that though after I gave you the name. Taylor was born in 1856 and was a foreman of the Midvale Steel Company in the I love this name, the wonderfully named suburb of Philadelphia called Nicetown, Pennsylvania. He was responsible for a number of processes at Midvale, and for each process, he asked himself two questions. What is the best way to do this job? And second, what should constitute a full day's work? That was 140 years ago, in about 1884, when he was thinking about making processes more efficient. Okay, fast forward 90 years to 1974. Okay, you probably can't read that. I'll tell you what it is. We called it then the course calendar for engineering at University of Toronto, 1974. So you can see how old I am. Maybe you probably can't read that. I'll help you out. Several of the courses, interestingly enough, I just looked at this a couple of weeks ago, relate back to what made Taylor famous, or at least famous among our little community of industrial and systems engineers. Some of the ones I circled there, which you probably can't read, are management science, production systems, system simulation, scheduling control, dynamics of general systems. So this is 50 years ago, right? But 80 plus years after Taylor. So fast forward another 50 years to today. Again, you probably can't read it. I'll help you out. This is today's listing, which is online. Obviously, there's no physical book, I don't think. And believe it or not, after 50 more years, several of the courses, the ones I've circled specifically, are the same or very similar to what was in my course book 50 years before. Integrated systems design, decision support systems, scheduling, organizational design, business process engineering. They're on the list today. They were on the list 50 years ago. Now, there's also a handful of more what I call fashionable courses, no disrespect, such as financial engineering, machine learning, data mining, and AI, all of which Taylor back in his day would have no idea what these meant, probably. Maybe he would on machine learning. Data mining, he might as well. AI, I doubt it. But all of which I'm sure he would be very intrigued with were he still with us today. Seeing AI subjects on industrial engineering's fourth-year course obviously doesn't surprise anybody. But seeing the longevity of some of the subjects Taylor essentially invented 140 years ago, I mean, that got my attention. I was quite impressed with that. You know, listening to the phenomenal work the youth students are doing these days puts me to shame. My fourth-year industrial engineering thesis project, along with four of my buddies, believe it or not, was a time and motion study at a hospital in Toronto called the Wellesley Hospital to reduce costs and to enable nurses who had sort of lobbied for this work to be done to be more efficient. Now, you can see where I'm going with this. Nurses felt they were doing too many menial clerical tasks, such as pushing stretchers to and from the operating room, running to fetch supplies, serving meals to patients. So one of our 5 team members, including me, rotated, and we were on site at this hospital almost 24/7 for 2 months with clipboards and stopwatches, is the way Taylor would have done it, recording statistics on every trip or task we saw to be used as we built up our Monte Carlo simulation database. Our work involved a simple linear program recommending hiring a handful of porters, surprise, surprise, to do these clerical tasks. And we optimized for different salary and value add as between porters and nurses. Now, we probably could have come to this conclusion without putting in hundreds of hours over 2 months. But unlike my material handling system at Dofasco, which never got built, by the way, this thing actually got implemented. So we were pretty happy about that, although it was a lot of work. Process re-engineering today is huge in banking, as it is in probably every industry. Okay. I'm not going to get too detailed here, but just to give you an idea of some of the processes we have in banking, the loan approval process consists of preparing files, collecting documents, sorting the completed files, submitting the files for approval, communicating decisions to customers. This looks like a relatively simple process, and in the scheme of things, in corporate loans, it is. But in the consumer business, with hundreds of thousands of loan applications a year at a large bank, it's a scale operation that demands extremely robust processes. For each application, there can be significant exchanges of unstructured documents, many employees handling each file, linking the customer, the lending officer, the adjudicator, and sometimes the lawyer. Or take the case of a bank wanting to enter into a set of financial derivative transactions with, let's say, a European food products manufacturer, so that this company could hedge its currency and commodity price inputs to protect its margins. This is a real live example I'm familiar with. These transactions would be subject to risk management, financial accounting, legal, and sometimes regulatory controls. There are few types of these transactions, but errors or misunderstandings here can be extremely costly financially and reputationally. A third broad group of transactions banks do are much more straightforward than the bespoke loans and structured deals I just described. This involves the millions of deposits, bill payments, other money transfers, and security purchase and sales, many of which are executed electronically. These involve less complex processes, but the scale of operations here is huge, and the negative ramifications as well of service outages and errors are massive. For all of these processes, industrial and systems engineers are continually immersed in work to make the processes simpler and faster, to reduce the amount of manual intervention, to ensure the right data exists at the right points in the process, and to reduce the potential for errors and fraud. At CIBC, architecture, data, and analytics are all together under one leader now. This team has over 100 engineers, 80 of whom are industrial and systems engineers. Tools today are less expensive, so the cost to make process changes to get $1 of savings has been coming down. When I was there, workarounds, as we called them, were much more common than they are today. CIBC and other banks are looking for permanent change right through the digital delivery chain. The leader of this group at CIBC said to me, "We need more engineers as process owners and fewer what we call coordinators, where people kind of get together and put a Band-Aid on something to get it up and running again." So apart from this obvious faster, better, cheaper benefit that accrues day to day, optimizing processes makes it easier to make changes down the road in response to changing product design features or regulatory requirements. For example, banks around the world over the last couple of years had to revamp their processes to incorporate required regulatory changes to the interest rates that governed most lending and derivative transactions, moving from what was called the LIBOR system to what's now known as the SOFR system, SOFR, or other rates of interest with a mid-2023 deadline. This was a mammoth task involving changes to a large number of processes. Banks that had processes handled by relatively few more streamlined systems were able to get the job done quicker and safer than those who had processes that were dispersed more widely. A large bank might have 2,000 to 4,000 processes, all mapped and documented in one place. Technology, as you can appreciate, is at the heart of most of these, but not all of them. One thing that hit home to me soon after moving from investment and corporate banking into the CFO job was that not all process change required large technology reconfiguration. Now, maybe that's intuitive to many of you, but it was a wake-up call to me. A lot of the process improvements simply required taking a disciplined approach to understanding the underlying objectives of what the business wanted to achieve and what the control function constraints were. Perfect job for industrial engineers. So let's now talk briefly about data, because it's closely linked to process management. To get good data, you need good processes, not only for AI, which we'll get into in a few minutes, but just to run your business properly in a highly regulated environment. In the late 90s, these are all the regulators that CIBC or BofA, the main regulators we answer to. In the late 1990s, I ran what was called the corporate lending business for Canada. Big business for us. I wanted to have access to data on an ongoing basis showing the key terms of the thousands of corporate loans that CIBC had made for the previous 20 years. Okay? This would help us understand the underlying key lending terms and covenants that were prevalent by client industry group and by credit rating, as well as the pricing terms and fees that applied. I had a similar database built a few years prior for various investment banking products that I was in charge of at the time, so I assumed it could be done easily. But I soon found that unlike the investment banking products, the data for corporate loans sat on spreadsheets all over the bank, and pulling them together was a huge challenge. In the end, we and our tech partners settled on a narrower approach that got us about 90% of the way there. So here's a high-level framework on how banks generally think about data management, which will tie into my next topic, and that's how banks are approaching AI. Starting with my time as a bank CFO, I thought of data fitting into two buckets, okay? First, data that you absolutely had to get right, okay? For example, financial statement data or anything that went to the regulators. And second, data that you needed to run the business where you'd like to get it 100% right, but that wasn't always possible, as long as you got it more or less correct and on a timely basis and in a user-friendly format. So naturally, the focus in data quality management is on bucket number one, where you needed 100% accuracy, or to use a manufacturing analogy, zero defects. This was the goal of General Leslie Groves. I won't ask you who knows him, but you'll know him in a minute. When he oversaw what was called the Manhattan Project in World War II. In the movie Oppenheimer, many of you saw the role of Groves was played by Matt Damon. Groves and Oppenheimer played by the Academy Award winner Cillian Murphy, the Irishman, had many memorable exchanges in the movie. The one that stood out for me, and there's a distant analogy buried in my little pitch here, was an interchange they had at a critical moment of their time together. Groves is pushing Oppenheimer on whether anything could go wrong on this project. Oppenheimer, of course, was the scientist that was making all this happen. Groves was the guy that the Pentagon sent to keep an eye on Oppenheimer, but he didn't know very much about science. He just wanted the right results. So it's about 50 seconds, 5-0. The first 20 don't really matter, but it's the last 15 or 20 that I love. So you play that, Pascal? Or I can do it here, I guess. Nope, I screwed it up.
What did Fermi mean by atmospheric ignition? Well, we had a moment where it looked like the chain reaction from an atomic device might never stop. Setting fire to the atmosphere. Or was Fermi still taking side bets on it? Call it gallows humor. Are we saying there's a chance that when we push that button, we destroy the world? Nothing in our research over 3 years was that conclusion. Except it's the most remote possibility. How remote? Chances are near zero. Near zero. What do you want for theory alone? Zero would be nice.
I love that. Zero would be nice. Now, I admit, bit of a stretch to compare the Manhattan project to the comparatively mundane world of data quality in the banking industry. But that is what banks are trying to achieve. That's what many businesses are trying to achieve, obviously, in QA. Zero defects are rarely possible. That's what customers and the banking regulators want and insist on. Areas where you needed zero defects always got first call on tech spend and people resources. That's why my corporate lending database took forever to build. Well, anything to do with, as I said, the financial statements or the regulatory submissions were top of the list. Data quality starts with good data sources. Pretty obvious. And data sources, both internal and external, have to be authorized. The term banks use, single source of the truth. Next, data has to be mapped to processes. By the way, I'm a Canadian, but spend most of my time in the US, so I sometimes say process and other times say process. I can never settle on one. As I said before, the two go hand in hand. Data source owners and process owners have to be explicitly designated. Then there has to be strict data testing, errors documented and plans put in place to fix them. Once you're satisfied that your data governance is robust, you can move on to structuring data in a format that helps you run the business better. For example, monitoring for irregular patterns of deposits and withdrawals in bank accounts that could point to fraud. Helping personal bankers identify customers who might be open to doing additional business, sometimes called the next best product. Someone who's paid down their mortgage might have money to invest in mutual funds. Allowing the risk management department to oversee, ideally in real or near real time, a particular type of risk, aggregated bank-wide, for example, exposure to oil or exposure to a particular country. And finally, banks have to decide how to use data warehouses as hubs between data sources and, between data source and capture processes and what are called transfer and use processes. So I think of this as the capture, transport, use integrated continuum. Putting this all together, you can get a sense of how critical good data management is for banks, particularly as they embark on their AI journeys. So let's talk about AI in banking. BofA's research group reports that the world now creates more data every hour than the world created every year two decades ago. And that's accelerating as we speak. New AI tools are emerging to analyze this data, and banks are staffing up to do this, as many companies are, but banks are, I'd say, pretty much at the forefront here, as well as big tech. Researchers, data scientists, programmers, and ethicists. But banks are proceeding cautiously to ensure reputational and regulatory risks are properly addressed. For example, the risk that data has not been sufficiently cleaned to exclude proprietary or copyrighted material, private client information, and to exclude data from narrow demographic populations, which may be implicitly biased. Transparency and traceability of decision-making is very important for financial institutions, as well, I'm sure, for other industries. Properly addressing all of this takes intense diligence and will take time, but the benefits longer term are significant. And regulation and legislation of AI globally is evolving as we're doing this work, as is the outlook for the amount, availability, and cost of the increased compute power required. Okay, here's a few stats I'll give you, which I think you'll be able to get. Maybe you've seen some of these before. So a recent report by the UK government, which has made, I'm on a board over there, they're making huge inroads on just how banks are dealing with AI as a prelude to their regulatory framework. So they worked with a consulting firm, Oliver Wyman, financial consultant, and noted that 91% of financial institutions in the UK have already deployed what they call predictive AI, as distinct from generative, in fraud detection or back office processing functions, already deployed. Over 70% have generative AI proof of concepts or pilot projects. I don't have stats for the US or Canada, but there's no reason to think it's much different than that from people I've talked to. The same report described the top 2 success factors, this won't be a surprise to you, for AI deployment in banks is obviously data quality, which we just talked about, but also seamless integration for your existing legacy systems. The UK report sets out the main bank AI use cases, which I'm sure some of you have heard of, along with their potential benefits in 3 groupings. Okay, first, cost savings. This is the biggest bucket. Reducing time writing code. This is a survey, 50 to 75%. Those numbers sound big to any of you. They sound big to me based on talking to people, but Microsoft is, I think, public at 70%. It will take time. Reducing time of processing information by analysts by 50%. Reducing time of call center staff by 30 to 45%. Second, risk management. Red flags that could reduce fraud by up to 5%. That actually seems light to me, but that's the number they got. And third, revenue generation, which is sort of towards the back end, reducing response time to priority clients by 50% and up to 5% higher revenue by increased client personalization. A huge amount of work continues to be put into Erica that you saw the brief clip on at BofA. Nikki Katz, who's head of digital, said in a recent interview, there's no room for AI in Erica to hallucinate, okay? Just absolutely unacceptable. We're dealing with personal finance. All the responses Erica produces, this is Nikki Katz speaking, everything goes through, as you'd expect, a really rigorous review to ensure she's not ad-libbing. And a lot of thought has gone into overall governance, and this is no different than most companies, I suppose. Processes banks have put in place around AI. Victor Dodig, a colleague and ex-colleague and friend of mine at CEO of CIBC, said this recently, and BofA has done the same thing. CIBC has introduced generative AI guidelines for all team members, a generative AI adoption and oversight council, and a pilot program to evaluate the ethical and responsible utilization of AI at our bank. as in other industries, AI is very much evolving in banking at what can probably be described, and frankly, as being done at a methodical, cautious pace. But make no mistake, the banking industry's aspirations, and I'm thinking big banks primarily, but also regionals, aspirations and financial commitment are no less than those of other industries. Now, the big tech is spending, obviously, significant dollars on generative. But it's just that the critical importance to banking, to individuals' personal livelihoods, and the tightly regulated nature of the business will probably continue to drive a measured schedule of product rollouts in banking. Okay? So it's hard to talk about AI in banking without talking about the cloud, and I'll just do that briefly. The benefits of the cloud have been well documented and fall within all three of the faster, better, cheaper categories. These benefits will become even more attractive as greater amounts of compute power are deployed to meet the growing demands for data analysis. The external or public cloud, many of you know, provides additional capacity and flexibility at a reasonable cost, while the internal or private cloud, particularly in an industry like banking, is so important because it provides greater security, arguably. The industry believes that. Like all big companies, banks need to continually assess what should be on premises and what should go external, or a combination of the two, which is what most banks are doing. With internal cloud uses being separate but linked with technology that allows data and application portability. Hybrid usage also reduces business continuity risk if outages occur in either public or private cloud. To the extent public cloud is used, banks need to minimize third-party concentration risk. And there's a few big players there that we're all using. But we need to spread that around to the extent capability exists to ensure sufficient expertise and ensure sufficient expertise is retained internally. And another tech-related subject actively discussed in the world is blockchain and cryptocurrencies. This is probably best broken down into three areas. Blockchain, the distributed ledger technology, tokens such as stablecoins and NFTs, non-fungible tokens, and other crypto such as Bitcoin and Ethereum. In blockchain, banks continue to test use cases in areas such as transaction accounting, trade finance documentation, compliance, ID verification for cyber, and potential data sharing for AML. But much of blockchain's required infrastructure is still being built in the banks. And some observers question whether some of the early fanfare in blockchain around potential improvements in speed, quality, and cost savings will actually materialize in the short term. So there's a bit of caution on blockchain, but lots of use cases being investigated. And finally, on crypto, a recent international survey asked bankers if they saw this as more of a risk or an opportunity. Majority saw it more of a risk. Now, some of this may reflect lack of subject matter expertise by some of the respondents, but still, I think there's a pretty cautious outlook on crypto within banks generally, partly reflecting uncertainty about how the regulators are going to treat this. So we've been quite cautious, and here are the linkages you're probably all familiar with. I won't read them off to you. And there's still lack of clarity how governance frameworks are likely to play out. Some are attracted to the financial innovation that crypto represents, but others are more focused on financial market stability and consumer protection. Today, several banks allow customers to invest in crypto ETF funds and to transfer money to crypto exchanges, but will not make loans to crypto businesses. And finally, on cyber. This is an area where you may have sensed from my comments, banks being a bit tentative and measured. There's absolutely no equivocation on the part of banks in fighting cyber. This is a do-whatever-it-takes approach to minimize the risk of a successful attack. Malware, denial of service, phishing, and other cyber attacks continue to escalate in all industries around the world. These are attacks, not successful attacks, but attacks. All banks are targets because of the volume of customer data they have. And although large Western banks have avoided really serious incidents to date, you may recall one of the large credit card companies fell vulnerable to quite a damaging attack in 2019 when an employee of a third-party supplier was successful in accessing 100 million customer accounts due to a breach in an application firewall in the company's external cloud server. So banks have detailed cyber playbooks and conduct desktop simulation exercises, many companies do. Not only are banks continually upgrading their perimeter and other related technology controls, but their broader cyber control framework extends to processes such as very strict hiring background checks, training of staff to detect suspicious emails and phone calls, monitoring data access breaches, and evaluating the cybersecurity systems of third-party suppliers. Okay? So that's a bit of a whirlwind tour of how banks are dealing with many of these tech subjects that you're either involved with yourself or perhaps interested in. I'm going to shift gears very briefly, as I said at the beginning, to talk about how boards of directors are dealing with all the change in the tech environment. Okay? I mentioned the DeFasco board, which I told you I never met, but turned down our project I had a hand in many years ago. Since that time, I've had the chance to appear many times with boards of directors. In my 7 years as CIBC CFO, I probably made 200 presentations to the board or to the committees of the board. And then, including the 5 years I was chief risk officer after the crisis started, financial crisis in 2008. And since then, after nearly 10 years as a public company director, I've been on the other side of the table getting presentations from people. And I know in the last question we had yesterday at the keynote touched on this, like, we've got great ideas in engineering, but like, how do we get them across the finish line? Not all of them need board approval, but the boards approve the overall budget, and in some cases approve large final or transformational projects. So I'll give you a few insights from my perspective as a board member. And some of this may be helpful if you ever have to present yourself to a board or even to a senior management group of your company who may not have the tech expertise or systems expertise that you have. So the main responsibility of a corporate board, as you may know, is to oversee execution of the company's strategic plan. And a big part of this is to ensure that the firm's capital is deployed in the best way. These are, let me just get caught up here. Those are some of the boards I've been on. So if a company's cash flow positive, it can either return the money to shareholders as dividends or stock buybacks, use them to acquire other businesses, or reinvest in tech spend or other spend in the company. Money spent on tech spend hurts reported earnings right away, and the benefits generally, not always, but generally are farther down the road. So that's why boards are interested in reporting earnings and the size of the tech budget. So when I was CFO at CIBC, I reported to the board at every meeting how we were doing on our largest capital expenditure projects. These were primarily IT projects. Several were over $25 million in spend, and a few exceeded $100 million, with the money often being spent over 3 to 5 years. For each project, I told them 3 things: how we were tracking the budget, how we were tracking to our time milestones, and how the project scope had changed, if at all. More scope or less scope. Our record on these wasn't great, although CIBC was no different than the other Canadian banks, as I found out in my conversations with my peer CFOs. This was despite the fact that we put a huge amount of time into our CapEx spending trying to execute to our plans. So why did we do so badly? After each major project was completed, we'd take the board through a postmortem on that project. For projects that failed poorly on our 3 measures, time, money, and scope, there were typically 2 reasons. First, coding and other development took longer than we expected, partly because of staffing pressures. For example, the knock-on effect of developers being delayed, finishing up other assignments. That's first. Second, changes that our team wanted to make to a project's design along the way. For example, the front line would want to make changes once they really started to understand what was being done. And the technology team generally would just try to accommodate and playing catch-up, which delayed and cost more money. The first cause for delays, just time delays because of conflicting schedules, I could kind of understand. We had a lot of projects on the go, and some of these were interconnected. The second cause, I had less patience for. This is changes they wanted to make along the way by not thinking about it in advance. Like, I was not then, and still today, I'm not what I would call a tech person, but it soon became clear to me that tech projects had to be owned by the front line. Okay, now it sounds logical, but in those days, it wasn't always done. An idea was put together, and the technology department would run with it, and then the front line would catch up and obviously would come up with other ideas. We concluded that the front line had to own the project from day one. When we started to enforce this, things improved. We still had challenges with the frontline wanting a high degree of customization. This made projects more expensive and hard to predict completion dates. It also caused problems down the road as tweaks were made to the original design. Now, here's a brief comment, not a video, but by a guy named Tim Spence, who's CEO of Fifth Third Bank, which is a big U.S. Regional bank, not as big as JP or Bank of America or Wells or Citi, but, in the next grouping. And he said, the obvious now, limiting customization is imperative to keeping our lifecycle management costs in check. We must adopt the workflow embedded in the base software package instead of customizing it to suit how we do our work today, ideally to less than 5% of the overall code. One of the challenges boards face today, not every board, but many boards, is that advances in technology have outpaced the experience and knowledge of the board members. I'm not talking about smaller private companies whose boards have company founders who are real experts, and a few other tech expert outsiders. I'm talking about larger industrial companies, financial services companies, and others who have boards who by design have a group of people with a diverse range of experience and skills, CEOs, other service industry people. Many of these directors, and I'm one, spent the early part of our careers in companies where the focus of technology was pretty much limited to the IBM 360 mainframe that ran the general ledger and many other systems. Today's world of digitization, blockchain, cybersecurity, and AI is all new. Now, many directors are very diligent, but they're playing catch-up. What this meant for me as a CFO presenting large CapEx projects for approval and reviewing our overall strategy, within which the tech was a huge part, was that I had to tailor my message to the audience, okay? So this is what I tried to do, and perhaps some of this may resonate with you. I was only satisfied if I got questions at the board from what I called the least tech-savvy board members, because that would, if I did get questions, that would mean I would, describe it in a way that even non-specialists could follow. Okay, so I started by, this is one of my favorite books, Stephen Covey, 7 Habits of Highly Effective People. Habit number 5, understand, then try to be understood. Pretty obvious, but so what I tried to do, and this is intuitive, be sure I understood it myself. I would bring on experts with me if it was really important, or if I thought I was going to get questions that I couldn't answer, but I would try to be able to address as many of the questions in general language as I could myself. But it started with really understanding it myself. Maybe I'll just skip ahead here. What have I got next? Okay. One debate boards are facing, and if your company may have gone one way or the other. Most companies today do not have a separate committee of the board called the Technology Committee, okay? Anything tech-related goes to the full board. But more companies are creating a tech committee. The 4 committees on the left are the typical 4 committees most big companies have, but some have a 5th, being the Technology Committee. The boards I'm on, we've decided not to make that change. We've felt that tech was something that was so important and such a broad subject that the entire board should see it. Another thing tech companies or rather companies generally are dealing with is whether they should have some real tech experts, quote unquote, on the board. Most companies have, I would say, avoided that unless they had a core tech specialization. And a friend of mine who succeeded me as the chair of one of the Ontario companies, I'll just read it to you. You probably can't read that. I think the jury's still out on this. I mean, Tim Hudson's view is there are very few issues that get to a board that are black and white. They're all shades of gray. The best board member is one who can think about an issue from multiple perspectives. If everyone just brings a singular perspective, the chair is going to have a heck of a job integrating those views, and the board's not going to function very well. But my punchline here is if you are presenting to a board where there's 1 or 2 tech experts, you've got to be sure they're on side. So my advice to you is be sure you work with them in advance. If you do not, and your board is a bunch of generalists, you've got to maybe tailor your message down a level from the tech, jargon that you'd use with your peers and colleagues in the exec suite. So against this backdrop of what I've just reviewed with you about corporate boards and their governance of technology, what advice would I give to you on your next or maybe your first presentation to a board? 4 things. As I said, know your audience, make an explicit connection between what you're presenting and the strategy of the firm. Keep the presentation as simple as you can, putting the details in the appendix, but making a list of Q&A that you expect to be asked and be ready with credible answers. And last, be confident. I mean, don't be tentative, but don't oversell either. I mean, everyone around the board table knows that there are risks in many of these projects. So you have to level with them and address what could go wrong and how you're trying to mitigate those risks. Okay? So I'm going to wrap with 3 stories of industrial engineers, very briefly, and how these are all, we've changed the names, but these are all folks that work at BofA, and they're all industrial engineering grads. And interestingly enough, none of them today are doing what I'd call hardcore industrial engineering, but they're drawing on the industrial engineering education and some of their early jobs at BofA. So Sarah joined BofA right from school as an intern, and soon specialized in information security and business recovery. So information security, that means cyber. Business recovery means, what do you do if you have an attack or any tech breakdown of any kind? How do you get a particular business up and running so that the customers are back doing business? So that's what she does today. Next up is a guy named, we call Gerald. So he joined mid-career, and this is happening more and more. And he spent all his time in one group, the Consumer and Wealth Products Group. He's worked on processes related to BofA's ATM channel before moving into various executive roles. Okay, so he leveraged his previous experience into, the Consumer Wealth Products Group at BofA, but he's an industrial engineering grad. And the last is a guy named Tom. Longer career. I think it's 30 years. 30 years at BofA. And he's done just about everything. The banks today for, exec level candidates tend to rotate people around. And not only did he work initially leveraging his industrial engineering training and process design, but later on customer service management, kind of the other side of these processes. I could go on. You can see, and this will be posted online, some of the things they've done in a little bit more detail. But the message is that industrial engineers are everywhere in the banking industry, and some of them are still doing the hard industrial engineering. Others are adopting or adapting the intuitive logical thinking skills that we all learned or are still learning in the training that we've been fortunate to get. Okay, so everybody has a call to action. Mine's, I kind of kept it quite simple, really 3 points. First, think about how some of the things you've heard me talk about in the banking industry that are going through today, development, process reengineering, data management, cyber, blockchain, the cloud, AI, may have applicability to some of the work you're doing. Now, I fully appreciate some of you the expertise is really deep and the pitch I've given you is pretty high level, but the breadth of it, I hope perhaps gives you some ideas as to what banking might be doing that might be instructive in what you're up to. Second, think about how you can be most effective, not only doing your work, but communicating your work. And this is something that can be taught and practiced and rehearsed by asking for feedback based on who your audience is. Because once you break out, I haven't a lot of heavy tech experience, but once you break out of your technology expertise, systems, process, data world, and have to explain it to someone, you got a different audience and you have to pitch it somewhat differently. So just encourage you, sort of obvious comment, I guess, to think about that and rehearse and get feedback. And third, and I'm not here to recruit people into the banking industry because I'm sure you're all well accommodated doing what you're doing, but someday down the road, if you're thinking of a change, think about banking. It's a fantastic industry that's changing almost as quickly as any other, certainly in that upper quartile. And it's just a fantastic place to be, and it's so important to the U.S. and the Canadian economies and the economy generally. So thank you very much for listening. Thank you for sticking it out for the last day. I've really enjoyed putting this together, and I hope some of that resonates with you. I'll take a few questions if you have any. If we have time, we got 48 seconds left. There you go.
There's two microphones
pretty good.
here.
Pascal was worried about me, I could tell. Now, I guess there are mics, over there, if you have any questions. If not, I'm going to hang around at the end if you want to chat separately. Nobody? Okay. Going once? Okay, thank you for listening.
Thank you so much.
Thank you. All right, thank you. All right, good.
I appreciate it.